All right. All right. Let's begin. So today we have two topics. One is corporate America in an earnings bubble, and then secondly, on the brink of a deal, take five or is it take 10? I can't remember where we're at. How many times we've been just on the verge, just on the edge. We're just gotta dot the I and cross the T, and we're there. We're home free. But we've been here many times before, and there's rumors circulating again today that we're just about there. But let's see where we really are. Let's begin with the bubble story. Last Wednesday, we talked about bubbles. So we're going to be talking about bubbles again. It's a very hot topic in the financial markets. And even though many analysts, investors say we are in a bubble, last week we walked through some reasons why I don't believe we're in a bubble. And we're going to continue this theme because it's such an important topic today. Now, when investors talk about bubbles, they always are referring to the price of an asset. In this instance, we're talking about the price of the overall stock market. And when we talk about a bubble, it means that investors are too optimistic about the future, and therefore they're willing to pay an excessively high price for the asset, the stock, in this case, the entire stock market. It could be a house. There's all kinds of bubbles. So the classic bubble that most investors have in mind is the run up to the 2001 stock market collapse. So between 1999 and 2000, you had this big buildup in the stock market, specifically in NASDAQ, where most of the tech stocks are located. And in those days, any company that had the name .com attached to it, those companies were priced at exorbitant levels. So in those days, the PE ratio on tech companies on average was about 47, right? By the year 2000, the PE ratio on tech companies reached 47. Now, today, we talked about this last week. Today, as a comparison, tech companies are valued at a PE ratio of 24.3. So you can see that, yeah, okay, there's some optimism, but it's nothing like the optimism that we saw in 2000. We also had a bubble in 2007, which was a housing bubble, right? The price of houses got so outrageously high that come 2008, we had a big housing market collapse that filtered through into the banking sector. The banking sector and a lot of other financial institutions were holding a lot of home mortgages on their balance sheet. So that all ended in a very nasty financial crisis. So that was a different type of bubble, a housing bubble. But if you just look at the PE ratio, as I said today, on the tech sector of 24, a little over 24, it doesn't compare to the PE ratio of the tech sector in 2000 when it was 47. So some of the more thoughtful stock market doomsday crew, some of the more thoughtful members of that doomsday crew, realized that to argue that we are experiencing a price bubble, it doesn't sound exactly right. Okay. And I mentioned the PE ratio on tech companies is a little over 24. On the overall S&P 500, it's only 21. That's not really very bubbly. So they've come to realize that the price bubble does not make a lot of sense. So they have pivoted, and they no longer say we have a price bubble, at least some of them, as I said, the more thoughtful members of the doomsday crew. Instead, they've switched to saying we have an earnings bubble. That is the denominator of the PE ratio, the price to earnings ratio. That denominator is too high, right? US corporations are producing incredibly strong earnings, and these incredibly strong earnings are pushing the price of the stock market up too high. Now, why is that? Because earnings are so exceptionally strong right now, because we're going through this unique period in financial history. Investors mistakenly believe that this exceptional earnings growth that we're witnessing, investors believe that it's going to last well into the future, but this crew argues it won't. And we're going to see earnings growth revert to a more normal, more moderate type of earnings growth that we've seen throughout history. So investors are in fact paying far too much for stocks because we're going through this earnings mirage. It's all a head fake. Uh, Again, this is a unique period in history. Yes, corporate earnings really are incredibly strong, but very quickly we're going to revert to where earnings growth normally is, to where the earnings growth has been in the old days, and as a result, the stock market is priced improperly. And as earnings growth cools, we're going to end up with an overvalued stock market, and the stock market is going to collapse because earnings are going to go down. So the denominator is going to go down, and that means the numerator price needs to go down, and that's our stock market crash. They also say, this doomsday crew, that this is the worst kind of bubble, right? Why is it the worst kind of bubble? Because earnings growth is so strong, it causes CEOs and corporate executives to become way too optimistic, and they are misallocating capital. That is, they're investing far too much money in these technologies like AI. So the CEOs, just like your normal investor, they're also getting fooled, and they're investing way too much of their capital in technology. So there's a quote floating around today from Jamie Dimon, and I've seen the quote on X. I didn't see the words actually come out of Jamie Dimon's mouth, and I've actually been searching for his words. I haven't found them. But he's quoted as saying that, in his words, personally, I think today we are over-earning. So if he in fact said that, and again, I don't have any crystal clear proof that he did say it, but it wouldn't surprise me that he might have said it because he tends to be a doomsdayer when it comes to the stock market. This is what he's referring to, right? Corporate America is earning too much, and it won't last. So let's tackle this concern. How serious is it? How concerned should we be? Well, first, what this group of investors and analysts are claiming, it's interesting to note, important to note, that we have never ever seen an earnings bubble in the United States, or for that matter, anywhere in the world. It just has never happened. There's no historical precedent for an earnings bubble. Now, that's highly unusual. It's highly unusual for something to happen that has never happened before in history anywhere in the world. So we've seen many stock market bubbles in history, right? We talked about the 99, 2000, 2001 bubble. But it wasn't the first. We'd seen many stock market bubbles, both in the United States as well as internationally. We've also seen many housing bubbles. 2008 wasn't the first housing bubble. If you look across the world, there's been lots of housing bubbles, lots of property bubbles. In fact, China's going through one right now. And you go through history, there's been a lot of them. There's been a lot of banking crises, right? The banking system in the United States has overlent and fueled bubbles and gotten themselves into huge trouble. So this has happened again and again in the United States and in banking systems throughout the world. But an earnings bubble, where corporate earnings growth suddenly accelerates, and then investors extrapolate and expect that strong earnings growth to persist well into the future. And it leads to distortions of CEOs, and they overinvest in technology or in certain industries, and you get a broad mispricing of the stock market as a consequence, and ultimately it leads to a stock market crash. We've never seen it before. We just haven't seen it before. It's not to say that specific companies haven't made these types of mistakes, but I'm talking about this happening across the entire stock market itself, an earnings bubble. We've just never seen it anywhere in history, anywhere in the world. And that's interesting, right? Because it doesn't sound like a crazy idea. It doesn't sound like something so weird that it should never happen, but it hasn't happened. I asked the question, why does something that could seem fairly reasonable, why hasn't it happened anywhere in the world? That's an important thing for us to understand. If we want to try to dismiss the idea that we're not in an earnings bubble, let's first understand why it hasn't happened before. What makes it so uncommon that it's just never happened before? Well, corporate earnings are much harder to bubble than asset prices. Okay, let me say that again. Corporate earnings are much harder to bubble, right? To get really wildly excessive corporate earnings. That's a hard thing to do. Whereas it's very easy to see an asset price bubble form. Okay, an asset price bubble is, a stock market bubble. That's pretty easy to happen. Why is that? Because the price of a stock or the stock market is ultimately just a belief about the future, right? It's a belief about the future. And if you get wild optimism running through a broad group of investors, you can easily end up with bubbles. And we end up with bubbles all the time. We end up with bubbles in individual stocks. We end up with bubbles in certain markets. For example, a certain housing market doesn't even have to be nationally, but it could be in a specific region. You could get a bubble, right? It just depends on mood. And human beings can be very short-sighted, and we can easily enter into FOMO, fear of missing out, and that can create asset bubbles. So that's easy. But earnings bubbles are far more difficult. So difficult that we've never seen it before. Why is that? Because earnings are constrained by the economy, right? If the economy isn't doing well, very well, then you can't have an earnings bubble, right? If economy is kind of sluggish, then by and large, the stock market, the companies that make up the stock market are not going to have very strong earnings. So the economy itself constrains corporate earnings. Secondly, even if an economy is doing really well, we live in a competitive society, a competitive system. So if one company starts generating huge earnings growth, that's going to create other companies to jump in very quickly, and that creates competition. So competition is another important force that prevents earnings bubbles, that prevents earnings from growing excessively. Third, consumer demand. Well, one way a company or companies, broadly speaking, can generate huge earnings is through pricing power. Okay? So if companies start increasing their prices excessively, what happens? Consumer demand diminishes. And as consumer demand diminishes, earnings growth falters. And that can happen very, very quickly. So in order for companies to keep their products competitive, they need to price properly. And proper pricing also keeps earnings from becoming bubbly. Next is wages. Anytime companies start to produce really significant earnings growth, you can't keep that a secret from the workers who work at these companies. So they will ask for wage increases. And those wage increases then cut into earnings, and that also keeps earnings growth from becoming bubbly. Another factor is interest costs. Companies need to borrow money to grow. And the more they borrow, the higher their interest costs will become, right? The more money you borrow, the more interest you're going to owe. And therefore, the more interest you owe, that will also bring down your earnings because interest payments are a cost. So the faster a company the more a company believes in itself, the more money it's going to borrow. The more money it borrows, the more it will cut into their earnings. So I could go on and on. There's a very long list. I'm giving you some of the big factors that prevent earnings bubbles. Okay, and again, asset price bubbles are easy. Earnings bubbles are so difficult that we've never seen them before. Now, so I've just sort of tackled this idea, why it's so difficult to develop earnings bubbles. But now I want to explain why, you might think based on everything I've said that it's hard to generate really strong accelerating earnings growth. But we are in a period of strong accelerating earnings growth. And I want to explain to you why we're seeing that and why I believe that rather than seeing a reversion to the mean, as the bears argue, I believe we are going to see earnings growth accelerate in the years ahead. And so that's what we're going to discuss now. But I don't believe it's an earnings bubble. So let's get into that. So technology, and specifically AI technology, modern day technology, AI, artificial intelligence, is probably what is known as a general purpose technology, right? It's not just another sector boom. It's not that AI is benefiting itself and no other industries in America or in the world are going to benefit from it, right? It is a general purpose technology that is going to be and is already being broadly used by households and companies. Now, historically, the biggest long duration earnings expansion, that is to say, the longest earnings expansions that have lasted for long periods of time, they come from technologies that change the entire economy, not just changing one industry. Okay, so what are some examples of these general purpose technologies? Well, electricity, that's an obvious one, right? Electricity benefited all households, all companies, the entire economy. Railroads is another one, right? Railroads had enormous benefits to everybody everybody in the world. Semiconductors. Why are we seeing, people have remarked that our SOX ETF, it's not doing so well today, but it's had an unbelievable run. Why is that? Because semiconductors are the powerhouse behind a lot of our technology, including AI, right? So this is a general purpose technology that is benefiting our entire economy. Computers, that's another one. The internet, that's another one. So AI probably, I would say almost certainly belongs to this category of all-purpose technologies that are benefiting the entire economy. And this is just beginning, right? We're not really, in the middle innings of these benefits. We're still in the very early stages, but it is happening. And I want to note that all of these technological advances that I just mentioned in electricity, railroads, semiconductors, by the way, airlines, I didn't mention airlines, that's another one. All of these technological advances have led to an acceleration of earnings growth that didn't last for a few quarters, didn't last for a couple of years, but the earnings growth that that was gained from these technologies lasted for many, many years. And it's still lasting, right? Computers, we're still getting better, more powerful computers. It's still benefiting us. It's still contributing to stronger earnings growth. But specifically, why does AI have this potential for being an all-purpose technology? Why is it? And I just want to go through some examples. Coding, right? We've all heard stories about coders being at risk of losing their jobs because AI materially lowers the cost of coding. I have many friends who are lawyers. My son-in-law is a lawyer, and he tells me the amount of time being saved in his legal work from AI, right? So it lowers the costs of legal work, right? Many lawyers fear that they're going to actually be put out of work because of AI. Customer service, drug discovery, right? We hear a lot about, hey, AI is going to absolutely revolutionize the ability to discover new drugs, new cures for cancer and Alzheimer's. You name it, every single day we're hearing, new. We haven't come up with cures yet, but scientists are saying, yeah, no, this is going to be revolutionary in terms of our ability to treat illnesses. Also in logistics and corporations, reducing costs of logistics, engineering, marketing, right? At the hours and hours that someone might spend on a marketing idea, AI is going to reduce time and cost there. Financial analysis. I've spoken to you at length of how AI has helped me in my financial analysis. Certain quantitative analyses that used to take me weeks or even months to do with teams of people, I can get done in 20 minutes now. So reducing the time and energy and costs of financial analysis and all kinds of other research. AI will help in manufacturing optimization. So if this is correct, I have no doubt that it is correct. The result of AI is not merely going to be higher revenues for the AI companies themselves. We are going to see AI raise economy-wide operating margins and productivity for companies throughout America and throughout the world, right? Operating margin, by the way, I mentioned the word operating margin. I don't want to throw out jargon without explaining it. Operating margin just means your basically it's your income minus your costs, right? So as your costs go down, your margins explode. So all of this matters enormously for corporate earnings. Okay. Now, all of this, all this is all that I've discussed just now on AI. It is going to drive productivity growth in the United States and globally. And productivity is the hidden driver of long-term earnings growth. Okay, what is productivity? Productivity is output per man hour worked. So if a man used to work an hour to produce, I'm going to just say something ridiculous, a cell phone, uh, and now he can produce 5 cell phones in an hour. That's productivity growth, right? So output per man hour worked. So again, productivity growth is the secret to corporate earnings. It's also the secret to GDP growth. So if AI meaningfully boosts productivity, that is output per hour worked, several things can happen simultaneously. Number one, as I just said, output per worker is going to increase. So every worker is going to produce more things. And as every worker produces more things, of course, corporate earnings will go up. but also companies will be able to scale their businesses with fewer employees. Okay, that's really important. You can produce more things with fewer workers. It also means that fixed costs are spread across a larger revenue base. What does that mean? If I have a big plant that produces a certain amount of goods, and now that big plant can produce more goods, okay, that fixed plant is my fixed cost, right? But now if I'm generating more revenues from this plant, right, my costs don't change, but my revenue base explodes. That's going to be incredible for corporate earnings. This also causes GDP growth to accelerate, right? If my economy is now producing more goods in a year, that means economic growth is accelerating, GDP growth is accelerating, and it's accelerating without a proportional increase in labor. I'm able to produce more goods without hiring more people. And the most important input, the most important cost for a company is wages. So if I'm able to keep my wages down and produce more, what do you think happens to corporate earnings? So the combination of everything I just mentioned is stronger GDP growth, stronger earnings growth for much longer than historical norms would imply. So everyone who is talking about we're just going to return to we're going to revert to the mean in terms of earnings growth, they're overlooking all of these incredible benefits from AI. They're just thinking of AI as being sort of a normal new technology. They're not looking at it like they looked at electricity or the railroad, right? This is that powerful. It's that generalized to revolutionize our economy, to create faster GDP growth for years to come, faster earnings growth for years to come. Now, I'm not done. This modern technology, AI, and I think there's going to be other technologies that are derivatives of AI. This will mean that businesses become more scalable than the old industrial businesses of 10 years ago, right? It used to be that to scale your business, you needed more factories, more workers, more inventory, more physical capital, and all of this translated into higher costs. But today is very different. Today, the dominant businesses are asset light, meaning they don't need big structures, big physical structures. They're very much software driven. They are globally scalable, right? They can operate anywhere in the world. And just think of a software platform. They can add millions of users with relatively modest incremental cost. So this creates, I'm giving you some very sophisticated financial technology, financial vocabulary. This creates what's known as very high operating leverage. What is operating leverage? Operating leverage is the degree to which a company's profits grow faster than its revenues. Okay? So I have a revenue stream coming in. Okay? But revenues don't include my costs. I could make $20 million a year in revenues, but if my costs are $19 million a year, then my profit margin is going to be pretty slim. But if my revenues are 20 million, but my costs are only a million, then my profit margin explodes. So all of these items that I just discussed, right? The fact that the fact that we don't require as many factories, we don't require as many workers, the fact that we don't require as much inventory, as much physical capital. This dramatically reduces my cost compared to the old days when businesses wanted to expand in the old days. They had to increase their costs. Today, I barely have to increase my costs to increase my business. And that means my margins explode and my earnings explode. And it creates durable margins that can last years. This is not just something that is going to last a quarter or two or three or four or five. It's going to go on for years. So this is why comparing current profit margins and comparing current earnings growth to 10 years ago, 15 years ago, doesn't make much sense. Okay? The economic composition of the marketplace is changing, and it's changing very quickly. So, for example, like the NVIDIA model is very different from the old steel and auto economy, right? Where to build a car, you needed huge infrastructure, huge plants, right? Going forward, the costs to produce a car is going to be much reduced. We're even talking about building houses with very low costs because of AI, right? That's probably not that far away. So we have reasons to be very optimistic about the outlook. And the bottom line here, I can go on and on and on and get into more detail, but I hopefully I've made the point that this is not an earnings bubble, but it's probably quite the opposite. Earnings are very likely to accelerate even faster than we anticipate. So the denominator, that is earnings in the PE ratio, is probably still too low, right? If we look out into the future. And if that's correct, that means that the numerator is going to go higher and sustainably higher, meaning the price of stocks, the stock market overall, is going to go higher and higher. And I think we have a very bright decade ahead of us in terms of the stock market. All right. Let's move on to the second part of this discussion, which is are we on the brink of a deal? Again, we've heard this not 4 times, not 5 times, not 6 times. We could be up to 10 times now that we've heard we're on the brink of a deal, or maybe even more. I've completely lost track at this point, and I suspect the president has also lost track on how many times we've been told that we're on the brink of a deal. So, first question is, why is Trump on so eager to cut a deal? And again, these are topics that we've discussed. We discussed it last week, but again and again, there's new ideas being introduced, and I think it's useful to delve into these new ideas. So I recently heard an interview with one of the great historians, a Harvard professor, Neil Ferguson. He's a Brit, but his focus is on global history, U.S. history, and he makes the argument, and it's a good argument, that the main reason why Trump is so eager to cut a deal, and even if it's not a great deal, even if it's a watered down deal compared to what his ambitions were at the start of the war. The reason why he thinks Trump is so desperate to get this war over with is because Trump lives with the fear that he is going to repeat the calamity of the failed hostage rescue that Carter led in 1979. If you recall, over 50 hostages were taken from the U.S. Embassy in Iran after this current Iranian regime took over the country in 79. The first act they did was to take over the U.S. Embassy and seize hostages. And then Carter attempted a rescue operation. And in that rescue operation, our U.S. Rescue jets got caught in the sand in the desert, and it turned into a real calamity. We lost airplanes, we lost pilots. It was a real mess. And Trump lives in fear of that. And if you recall, while the war was going on, right actually before the April 8th ceasefire began, we had uh, some pilots go down in Iran, and we launched a very daring rescue operation, which was incredibly impressive. But Neil Ferguson argues Trump after that got really cold feet and for the first time saw the real risk that he was running. And from that point on, he wanted to get out of this war. And Trump just fears a loss of life, a quagmire. So these are some of the things that Neil Ferguson discussed. And of course, we've got other things that we've discussed before, the high inflation, so he wants to get inflation down, especially before midterm elections. There's also this concern that we've used up a lot of weapons, and we don't want to have weapons shortages if we have to confront China trying to get aggressive against Taiwan. We've discussed some of these topics before. I don't want to get into those, but the new one is the one that Neil Ferguson discussed. And it's interesting. Um, do I think it has merit? Sure. I think Trump absolutely fear. I think a lot of these, inflation, midterm elections, oil prices, uh, the topic of weapons, these are all reasons for why Trump may want to call this quits and rush to an agreement. Now, another thing that Neil Ferguson argues, which is linked to Trump's thinking of why he wants to get out of this war, Neil Ferguson argues that this oil shock that we're facing is bigger than the oil shock that the United States faced in the early 1970s. In 1973, the Arab oil producers implemented an oil boycott of the United States, and that sent oil prices skyrocketing, and it led to a protracted period of stagflation, very low GDP growth, and very high inflation. And that lasted for a very long period of time, ultimately until Paul Volcker took over at the Fed and raised interest rates and caused a recession, a protracted recession in the early 1980s. So Neil Ferguson is arguing, we're running the risk of a 1970s style oil price shock. And Trump needs to be very concerned about it. And that's also on Trump's mind and the reason why he wants to get out of this war. Now, here's where I really have to part ways with Neil Ferguson, who is a historian. He's not an economist, he's a historian. And he doesn't seem to realize that to compare the US economy today to the US economy of the 1970s is a very poor comparison. The US economy is far less oil and gas intensive than it was back then. Uh, Most economists estimate that we use about 70% less energy that comes from oil and gas today than we did in the 70s. So we're far less dependent on oil and gasoline than we were back then. And so therefore, we are far less at risk from the stagflation that we saw in the 1970s. Back then, back in the 1970s, just to explain this point, our economy was massively industrial. We were an industrial economy. We were manufacturing intensive. We were steel intensive. We were automobile intensive. And all of these industries are heavily, heavily reliant on energy. Whereas today's economy, a lot of people say, oh, too bad we're not heavily industrial and heavily manufacturing. The truth is, it has a lot of advantages. Because we're not so industrial and manufacturing intensive, we're not so energy dependent. Today, this economy is reliant more on software, on healthcare, on finance, on digital services, on intellectual property, on cloud computing. So none of these industries are heavily reliant on fossil fuels the way we were back in the day. So this composition of our economy matters enormously. So if you just look at where the S&P 500 profits come from, they largely come from technology and service firms where not much energy from fossil fuels is consumed. Contrast that to the stock market of the 1970s, where it was made up of industrial firms that were, big manufacturing, very, very fossil fuel reliant. So it's just a completely, completely different economy. Uh, Also, just look at the cars back in the 1970s. Cars were extremely inefficient. They were gas guzzlers. Fuel economy standards didn't really exist in those days, or they barely existed. The engines were much less advanced, so, much less efficient. So the engines today are far improved. We have very high standards for efficiency, fuel efficiency. Hybrids have emerged, right? Electric cars have emerged. So again, just even your average household, we're all consuming far less fossil fuels than we once did. I'm gonna go on just because it's such an important point. If you look at buildings and appliances, right, modern air conditioners and refrigerators are much more efficient. So they use much less energy. Our insulation of our homes is much better. So we use far less energy per unit of GDP produced. So just by the way, I made a list of things. LED lighting alone is an extraordinary efficiency gain relative to the older technologies, right? So we can just go on and on and on and make this point. I'm just kind of running through it superficially, but you know, today we have nuclear energy, we have renewables, we have hydro, we have solar, we have wind. All this diversification reduces our vulnerability to a single energy source, in this case, fossil fuel. So therefore, the bottom line is that an oil price increase has a much less impact today than it did decades ago. But that's not the only part of the story that Neil Ferguson misses. He also misses the fact that oil prices just haven't gone up that much, right? If you were to use today's oil prices and apply it to the 1970s, uh, oil prices would have to go up to 200 a barrel, right? We didn't go much above 100 a barrel. So oil prices just, they were double the increase in the 70s compared to what they increased today was double, right? So the oil price increase is wildly exaggerated. Um, But I want to go on. I want to continue to make the point that the spike in oil prices isn't nearly as bad as Neil Ferguson suggests. And it's not, I'm picking on Neil, who again is a great historian, but this is a mistake that's made by nearly everybody, economists, people in the financial markets. They're so worried about the price of oil and the damage it's going to do to the economy. Think about this. We had a very serious inflation spike that began in the fourth quarter of 2021. It accelerated into 2022. and persisted into 2023. Okay, and this was a result of a combination of COVID, which caused a massive decrease in supply. Okay, so you had a big reduction in supply. Then you had a huge increase in government spending, so that contributed to a big increase in demand. Plus, huge, interest rates were cut to zero. On top of that, we had money printing. So you had all this demand and very limited supply, and you had a big spike in inflation. Much larger than the inflation spike that we're having today. So, and it wasn't just oil, right? Oil also skyrocketed because Russia invaded Ukraine, and oil prices went to 125, 130 a barrel, above where they went recently. And we did not have a recession. So Neil and many other people are saying we're going to have a recession because oil prices went up. But what about 2021 through 23 when it wasn't just oil? Yes, oil prices went up, and so did the price of everything else, like building supplies, like cars, like food. And we didn't have a recession. And yet we're going to have a recession because of oil prices went up, and they didn't even go up nearly as much as they did in 22. So this is just poor economic analysis. Now, Neil Ferguson and others have also made the case that it's not only oil prices, but bond yields. Look at the 10-year bond yield. The 10-year bond yield went all the way up to 4.6% a few days ago. Right now, it's below that. Right now, it's 4.47. So it's come down a bit, but went all the way up to 4.6%. But let's just take an average. Bond yields at 4.5%, let's say. And they're saying that those bond yields, that is dangerous. That is going to also contribute to a recession because borrowing costs are going up so much. Well, from between 1950 and today, the average yield on a 10-year bond is between 5 and 5.5%. It's within that range. So we're somewhere between 50 and 100 basis points below the average bond yield since 1950. And yet, all these people are saying that bond yields are going to cause a recession. Have we been in a recession every year between 1950 and today? No, we've had very few recessions, and the average bond yield on the 10-year bond is well above where we are today. Doesn't make much sense. Yes, bond yields have gone up, but they didn't go up that much. During the Biden presidency, bond yields were here for a long period of time. When Trump first came into office, bond yields were here. Yes, they went down to briefly, very briefly, to about a little over 4%. Okay, so they're about 50 basis points above where they were at the low during the Trump presidency, at the low, low, low. But they're lower than they've been on average in US history, and they're just not that high. These are not such penalizing, punishing bond yields that will cause a recession. Okay, so I wanted that was a really important topic I wanted to cover, right? So again, we were discussing why Trump may want to end this war. We went over some important reasons. One of these reasons could be that he's worried about oil prices and a recession and incredibly high inflation, and we sort of brushed that one away. If Trump's worried about it, he shouldn't be. It's just the price of oil isn't that high, and bond yields aren't that high. Now, he might be worried about it, but I think unnecessarily so. But we're still on this topic of Trump and wanting to end this conflict. Some will argue, you know what? to make a bad deal with Iran, and I'm in this camp, make a bad deal with Iran. And what's going to happen? What's going to happen is, best case scenario, Iran is just going to wait it out. Trump's term ends, and in a few years, right? The next president gets sworn in, and we just have to wait a few more years. And come, January 20th, 2029, you have a new president, and um, and then Iran can rebuild its nuclear program, rebuild its missile program, and they're off to the races. So any deal is a terrible deal. Even if Trump gets pretty much everything he wants from Iran, it's still a bad deal because we know who Iran is. We know who this regime is, and they will not back down. And I'm very much in that camp. So it raises the question, why doesn't Trump just go all the way? Why doesn't he go for regime change? Forget about making a bad deal. And there is the conventional wisdom out there is that you cannot do regime change. Not only can't you do regime change, you can't even really win a decisive victory without sending in ground troops. Right? If you let, after all, and everybody looks at World War II. Right? We toppled Germany. We toppled the Axis powers. How did we do it? We sent in massive numbers of ground troops. That's how you bring about regime change. And that's really the example everybody has in mind, right? You want regime change, and there's just no way Trump is going to send in large quantities of ground troops. It's not going to happen, and no American would support it, right? So that is always what I would call the straw man of, Trump should just cut and run at this point, right? There's no regime change. There's not even an outright victory. Let's just, you know, let's just end this thing and call it quits. And I call this argument a strong man because it's not really true. It's not really true. Uh, let's just go to World War II. Okay, yes, we sent ground troops into Germany, we sent ground troops into Italy, but you know where we didn't send ground troops to? Japan. How did we defeat Japan? How did we defeat Japan? You all know the answer. With an atom bomb. Two atom bombs, in fact. So I'm not suggesting that we drop nuclear bombs on Iran. But we can absolutely escalate well beyond the point that we've escalated, right? We can take out their nuclear facilities. Their oil facilities, their oil infrastructure. We can wipe it out in about 5 minutes. We can also wipe out their electrical grid in about 10 minutes. And then you really strangle the regime, right? I don't think anyone really argues that this regime could survive that type of attack. But we don't do it. Why don't we do it? Because it's become unacceptable in modern warfare. And it gives Iran a complete asymmetric advantage because they can behave like complete barbarians, but we're not allowed to behave like we did in history, the way we won wars. And again, not even close to the level of ferocity that we used against Japan. But even Bill Clinton took out countries' electrical grids when he fought wars abroad. We won't even resort to tactics that we used, 20 years ago, 30 years ago. So we don't need to send in ground troops to win and to topple the regime, but we would need to use greater military ferocity than we've used to date. But there are other examples of the United States toppling regimes without sending in ground troops. And I'm just going to mention a bunch right here. The Soviet Union doesn't exist anymore. We never sent in one troop, right? East Germany doesn't exist anymore. The communist Poland doesn't exist anymore. Czechoslovakia doesn't exist anymore. These were the old communist dictatorships. The communist Hungary, communist Ukraine, they don't exist anymore. We sent in zero ground troops. How did we do it? We did it through playing geopolitical hardball, right? In this case, we could do it against Iran by not sending in ground troops, but by maintaining a noose, an economic noose around their necks for a protracted period of time. There's a decent chance the Iranian regime couldn't survive if we just maintained a naval blockade for the next year. And if you did that in combination with more severe military attacks of the sort that I indicated just a couple minutes ago, the likelihood of regime change would be very high. And the only way you're ultimately going to solve the problem in Iran, right, to make them a non-dangerous actor for years to come, is through regime change. Regime change has become a dirty word, but that's the reality. Now, just to further push back, as if ground troops, which are intolerable, are actually the magic bullet, right? Oh, we're not going to send in ground troops, and we shouldn't, but if we did send in ground troops, that would work. Really? Do we forget Iraq already? Do we forget Vietnam already? You know, it's amazing how people twist and turn to make arguments to back up their views. But other examples are, Afghanistan. We sent ground troops into Afghanistan. We didn't achieve regime change. Cuba, if anyone remembers in the 1960s, the Bay of Pigs crisis, we sent in troops to topple the regime in the Castro regime in Cuba. That also didn't work. So ground troops are definitely not necessarily the answer. And we can definitely, even though everyone says you can't cause regime change from the air, we did it. We did it in Japan. We can certainly do it here if we had the will. And we've done it with playing economic hardball in all the communist countries that I just mentioned. We could do it with economic hardball as well. You don't necessarily, by any means, need troops on the ground, and troops on the ground may actually not even work, as they didn't work in many other places. So let's get back to the deal, okay? Why is it that on almost on a daily basis now, we're hearing deal and then no deal and then deal and then no deal? And nobody really knows the answer, but I have a good hypothesis that that I heard uh, from a few pretty well-informed people. On the U.S. side, you have Trump, and Trump knows exactly where his red lines are, right? He knows what he's not willing to concede. But he's got a set of negotiators. And those negotiators may not be completely aligned with Trump. Who are his two lead negotiators? They're Steve Witkoff and Jared Kushner. Now, both of these are trusted confidants of Trump. Jared Kushner is Trump's son-in-law, and Steve Witkoff is a close friend from his real estate days. But both Kushner and Witkoff have interests in the Middle East. Both of them are heavily, heavily invested in the Middle East, have close business relationships with Qatar and the Saudis, and even some other Arab countries in the Middle East. And Witkoff and Kushner could very possibly want this war to end because it's in the best interest of their businesses, and they have a lot of money at stake. So their incentive very well may be get a deal. Get a deal as soon as possible. End this thing. And I'll get a deal, and then I'll go and try to convince the president that this is the best deal we can get. Now, on top of that, you have a lot of people within the Trump administration who hate this war. They hate conflict. They hate U.S. involvement abroad. And they want this to end as fast as possible. So anytime you have Kushner and Witkoff coming back saying they have a deal, these people within the administration who are desperate to get a deal run out to the social media and the media and they start leaking, we have a deal, we have a deal, we have a deal. Not only that, because we hear from Trump himself many times, we have a deal. We're close to a deal. Because Kushner and Witkoff tell Trump, we have a deal. But they haven't yet sat down with him and gone over the details of the proposed deal. And then once Trump hears the details of the proposed deal, he says, no way, this is not what I wanted, right? This crosses my red lines. So that's what you have on the Trump from the Trump team. And it leads to a lot of misdirection, leaks that cause the stock market to run up, that causes the euro to rally, right? People start buying into these rumors and they turn out to be false because Trump hasn't signed off on them. The deal as it's presented crosses Trump's red lines and it's unacceptable to him. On the Iranian side, something similar is happening. You have Mojtaba Khamenei, who apparently seems to be alive, but he's hidden somewhere underground. Almost nobody has contact with the guy. Nobody knows where he is. When I say nobody, I mean even people in the Iranian government, the high level people in the Iranian government don't even know where he is because they're so worried that he can get eliminated by an Israeli airstrike that he's well hidden. But his negotiators go out and they also want a deal. They want this war to end for personal reasons. They want the cash flow to start coming in again, right? They want to start making money. They want those oil revenues again. They want the sanctions to be lifted. They have families to feed. They have luxurious lives that they want to return to. But Mojtaba Khamenei, the leader, he has his red lines. And his red lines are crystal clear. He wants a nuclear weapon. He will not surrender as Trump calls it, the dust, the highly enriched uranium. He's not going to surrender it. He's not going to surrender his ballistic missiles. He's not going to surrender anything on what's core to him. So Trump and the leader of Iran are very far apart. But the negotiators are very close. So we keep hearing from the negotiators that we're right there. But then when it comes back to the two leaders, we realize we're very far apart. So that's where we are in terms of the deal. And this is why we keep hearing again and again, take 5, take 10, take 20. We're right there. But at the end of the day, can we get a deal? I'm not going to say it's impossible that we get a deal, something very superficial gets signed on paper. But there's no way this deal is going to last. There's no way this deal is going to last. And my base case remains that even though Trump very much wants a deal, ultimately he's going to see there is no deal to be had. And he's going to, at a minimum, have to resort to more military pressure to increase the costs on Iran. And he may think I'm going to increase the costs on Iran and make them come to their knees and I'll change their minds. And ultimately I'll get a deal from them because I'll intensify the cost so high that they'll change. Personally, I don't think it's possible to change the minds of this regime. This regime will always remain this regime. The mindset is unchangeable. And therefore, the only solution is regime change. And we might ultimately get there, but Trump would have to be dragged into it, would have to be dragged into it, just like he's being dragged along into no deal, no real deal anyway. He wants it. But what he doesn't seem to understand yet entirely is that the leader of Iran will not budge on the things that are so dear to Trump. All right. We're a little over the hour point, so let's see if anyone has any questions.